Good evening, ladies and gentlemen. This is Barry Norman on behalf of Alvexo and Invested.com, and welcome to our webinar. Tonight's class is sponsored by Alvexo, who is a regulated provider of Forex and CFD trading. They are regulated under many regulatory authorities throughout the world, and when you trade with Alvexo, you know you're trading with one of the best retail brokers in the marketplace. You can trade with them using their web trader, because you don't have to download anything. You can sign on from anywhere and trade in no time at all. If you want to open up a demo account, you can go to their website right now and just put in your name, your email address, and I believe pick a password, and you'll have a demo account open that you can try out in no time at all, so you can get prepared for tomorrow's Federal Reserve decisions. You also can download their MT4 Trader platform, which is one of the most advanced trading platforms you can use in the world. It allows you to have multiple type orders, and at the same time you can even build your own robotic trading and download expert advisors right to your charts and do whatever you want with the MT4 platform. They also issue signals to you every day, and they're free of charge. And tonight, we're going to be talking about the possible market volatility ahead of the Federal Reserve decision due tomorrow. Now, one of the biggest assets, or one of the most responsive assets to the Federal Reserve, is gold. And it seems like whenever the Federal Reserve is making a decision or coming out with something, everybody wants to trade gold. Now, since the dawn of time, gold and silver has been recognized as valuable. And even today, precious metals have their place in a savvy investor's portfolio. But which precious metal is best for investment purposes? Now, we know for trading, it's gold followed by silver. Now, why? When banks and money are perceived as unstable or political stability is questionable, gold has often been sought for a safe store of value. And just little increments. Just the skirmish in North Korea has pushed gold up slightly. Just to mess with Donald Trump and the testimony in the U.S. has pushed gold up slightly. Because as traders, not traders, as investors. And let's separate investors from traders. As investors, and there's lots of very, very wealthy people, they're not looking to actually make daily profits in gold. They have big managers who manage their multi-billion-dollar or million-dollar estates, and they have a good deal of their portfolio in gold. They're looking for a nice 10 or 12% return over a many-year period of time. Or they're looking for stability when all their other assets are crashing, or when there is world worry. So you might want to store your money in gold, because gold has no actual value. But systematic financial concerns push up the price of gold. So does inflation. Okay, inflation is a big pusher of gold. So is war and political crisis, and so are interest rate decisions. Now, the Federal Reserve has a direct effect on gold. It's going to have a direct effect on the U.S. dollar. It's going to have a direct effect on the U.S. stock markets. Okay. But the question is, what's the best way to make profit? Or is there any chance of making profit? Now, the fact is, when the Federal Reserve decisions are really up in the air, or up till a year and a half ago or 2 years ago, when we saw the first reversal in the first rate increase, every month it was, is it going to be up? Is it going to be down? Are they going to make a decision? Or they're not going to make a decision? And gold, the dollar, the stock market were bouncing back and forth, back and forth, back and forth. But now, and especially for this June meeting, everybody is pretty much sure that the Feds will raise rates. So the U.S. dollar has been soft moving into the meetings, the next 2 days meeting and their decision on Wednesday. And this might be an omen of what's to come, because when the Federal Reserve futures they're pricing at 100% chance of a 25 basis rate hike this week. Expectations for a third hike in 2017 have been decimated, and no month the remainder of the year eclipses the 60% implied probability threshold, suggests markets have a high degree of confidence in another policy move. So right now, there's almost 100% chance of a rate hike this week. So that means any possibility of profit, big profit in a short-term basis is already factored into the market. Gold has made its moves. The dollar's made its move. The S&P, the Dow, the markets are trading, bounce back and trading at highs once again because they're all past this rate increase. But there are some crucial points of what might happen with the Feds that might open up some possibilities. Now, it's looking like the Feds will be marking down some of their forecasts, which is implicitly a dovish move. Inherently, we appear to be headed towards a dovish hike, means they're going to raise rates, but there's not going to be a lot of conviction, whereby the Feds raise rates but cut expectations for future policy endeavors. And this is what we're going to be listening for tomorrow. So there is nowhere between tonight and tomorrow's decision that you can really be placing bets because the market has been oversaturated already. Everybody has taken their side. Now, you can be a contrarian and decide, I'm going to outsmart them all because I think the Feds are going to do something crazy. And they could do what's not expected, but they're not going to do anything crazy. So what we're going to be looking for is a 25 basis point, which is basically a assured thing. What we're going to be listening for is, will the overall statement turn to more dovish? Will they be less pushing for that third increase in 2017? And will they be cutting back their forecast of rate increases into 2018? Because there is no guaranteed commitment of these. This is just their implied thought process at this time. Okay. So if we get a dovish Fed reaction, we have a rate increase on one side and a dovish Fed on the other, it neutralizes the two sides of the moving parts. It might help the stock market because the weaker the dollar is, or the lower interest rates stay low and the longer they stay low for, the better it is for stocks. Better is for businesses. They can borrow more money. They can pay less interest on their debt. So we've already factored in they're going to pay a little bit more. But if the Feds push back the next rate increase and the next ones after, because businesses are looking for long term. So it might help push the S&P and the Dow up somewhat. Okay. Now, we are looking at some overall implied movement on some of our major currencies, but they've already been factored in. So where do traders stand now? We can see where the traders have taken position already. Okay. We have 70% of the people in the euro US dollar are trading it short. So that means they're expecting it to go down. The US dollar JPY is expected to climb. Okay. We have, the pound is more or less almost even. The Australian US dollar is more or less even. Gold, the dollar is, we're looking at strength in gold. And the S&P, we're looking at a drop, where we have lots of people short in the marketplace. So the signals are bullish for the euro US dollar, a weakness or bearish for the USD JPY. But remember, they're reversed because the euro US dollar, then the US. So that means what we're looking at is weakness in the overall dollar. Okay. Because even though we get a rate increase, which should strengthen the dollar, the dovish Fed would weaken the dollar. Now, the US dollar index, which tracks the buck versus its main rivals, has reverted to the negative start and is now heading towards a daily high of about 97.30. So we can see the dollar has been steadily, when Trump was first elected, we saw the dollar over the 100s. It's been steadily falling, and it's now trading way down from, much lower than where it's been. Okay. So fresh buyers seem to emerge around the 97 point handle today. sparking an ongoing correction higher amidst a continuation of recent rebounds in U.S. yields. In fact, the 10-year benchmark is advancing for the fourth consecutive session today. So 97 or 97.50 for the dollar would be good, but we're seeing the dollar fall all the way down here, seeing lows of 96.51. Okay. The dollar index was up 2% in 97.26, and it broke above 97.47, the June 19th high, or a break above that might push it up to 97.70, and then finally to 98.51 if it's going to rise. But again, it's all going to depend on the Federal Reserve statement and outlook. Okay, even if it's dovish, how dovish does it mean? And we're going to talk about that later, what we're looking for in the... Somebody asked, what does 97 mean? The U.S. dollar index is trading at 97. That's the price of the U.S. dollar index. It's a standard price everywhere. It's what the U.S. dollar is worth. Okay. Now, we see that overall, we see traders with most at stake from the Federal Reserve's price policy decision see a rate hike this week as practically a lock, and they have started to put their money on the follow-up boost for December. Okay, so this is where the price of the dollar, or where longer-term traders are going to start moving into. So depending on what the Fed say, they're again looking at where we're going in the future, because people aren't just looking for today. With the dust settling after Thursday's UK election, the Fed's June 14th decision is the next focal point for investors. In the euro-dollar futures, where traders place bets and hedges tied to the path of the central bank policy, confidence is building that after Wednesday's officials pause in September and resume raising borrowing rates at the year end. So we're going to expect them to not do anything in September. In the last 2 years, they have raised rates in December. So positioning the market for short-term interest rate shifts towards December after a disappointing jobs data June 2nd. Last week, we had a very disappointing one. Unemployment was way down. It's the lowest unemployment was at 4.3. But we're expecting 185,000 jobs. We only got 138,000 jobs. But again, the markets in the long run look at it on quarterly and semi-annual, annual basis. So they're not as reactionary to one disappointing rate. But the quarter has been all right, but not as good as hoped for. So the figures from the jobs report prompted Goldman Sachs to push back expectations of a third 2017 increase to December, leaving room for the Feds to unveil plans in September for shrinking its balance sheet. And now, this is the other thing that we're going to be looking at very closely, is will they make any timing effort, any statement, any concern about their balance sheet? The balance sheet is, the U.S. has stopped all their quantitative easing, buying up bonds and everything else quite some time ago. But they have to start unloading everything that they have. And there's something like $43 trillion worth of stuff that they own. They've got to start selling it back into the marketplace. And at what point will they start this? And we expected originally the Feds to maybe say at this meeting that they might start unloading little bits at a time, not anything significant, but start putting this back into the marketplace. Now, we're expecting the Feds to push back their September expectations and maybe put this off to September. All of this information, when the Feds release their statement, is going to be what traders affect and how they react to the rate increase. Retail traders data shows that 30.2% of the traders are now net long, with a ratio of traders short to long at 2.31 to 1. In fact, traders remain net long since April 18th, when the euro-US dollar traded at 105.975, because traders have been buying up the dollar ever since it hit a bottom. Anybody who didn't buy when it was the 105 range was crazy because that was so low that you knew in a longer term it was going to bounce back. The number of traders with net long is 9.6% higher than yesterday and 2.1 higher than last week. This means that they're expecting the U.S. dollar to weaken and the euro to strengthen. Okay, so this is the overall market outlook. Gold prices have been quieter. There's a lack of new bullish fundamental development on the geopolitical front, which means gold was pushed up because of Korea, was pushed up because of this Qatar stuff, the Mideast stuff, and pushed up over this Donald Trump stuff. And so gold has been able to ease back because risk sentiment is eased off and risk off environment is eased off. Doesn't mean that the U.S. dollar or the Fed rate has changed. The Fed Reserve is expected by many to slightly raise interest rates. Traders and investors are also keen to see if the Fed's act to further reduce its big balance sheet on government securities. The gold bills still have an overall near-term technical advantage. However, they are fading and need to show some fresh power soon. Prices are still in a 4-week-old uptrend in the daily's bull chart, but just barely. Gold bull's next upside near price term breakout objective is to produce a close above the resistance at 1300. Doubt if it's going to get there. Okay, so let's go over, if I take a second before we go over, and let's take a look at some live charts to see where the markets are at the moment. Let me pop them up on your screen here. So we see the U.S. dollar is trading right now at 97.01. Okay. It's been in a steady downtrend for most of today and the last few days. Okay. So gold, dollar has already, the dollar is expecting, the rate increase has already been factored in here. Traders are expecting a very dovish Federal Reserve meeting, and this is all developed. If that jobs report last week had been very positive, then we would have been expecting a more hawkish outcome. So we're looking for this. Okay, so this is where the traders have already factored in. If the Fed take a very hawkish outlook, we could expect the dollar to climb at least back up here to this level. Okay. Now, we can take a look at gold real quickly. And look at where traders have been pushing gold. Now gold and the dollar work inversely, and gold and the dollar also react to rate increases. Gold goes down when we have a rate increase, the dollar goes up with a rate increase. Okay. Gold has been falling significantly down, okay, because the tension out of North Korea has eased back a little bit, but it's still tense. Okay. Qatar is not overwhelming and there's no overly reaction. So gold, the risk sentiment in gold is eased off. We're expecting this rate increase. Okay. Gold might get a good bounce if we have a very dovish Fed, but otherwise gold has factored this in. So that's why I'm saying 1300 is way out of the question. And I think we're going to see gold stay in, I'm sorry, I'm not drawing straight lines here. But this is what we see here are the traders taking position, okay, in front of the Federal Reserve. So we have gold at 1266. If we have, it's got to be a very, very hawkish or a very, very dovish Feds pushing gold one way or the other. If the Feds, are fairly dovish and they have the 25 basis increase, you can see gold stay around here. If we see the Feds very dovish, in fact, pushing off another rate increase in 2007, you may see gold bounce back up to here. Unless we have some kind of geopolitical stress, I don't think we're going to have much of a reaction. With the euro-US dollar, let's look at this in 1 hour chart. The euro-US dollar as you can see, the euro-US dollar climbed tremendously. It's had a big rally from, no, it's been steadily. We've gone into an adjustment and consolidation period. Although the U.S. dollar has weakened, and it's not the euro is strengthening, the U.S. dollar has weakened, as you saw in the charts before, but we still see it locked in this 112.0 say range. We have it topped out here, somewhere along here. Don't expect much more to happen tomorrow. Got it topped out along here. Again, if the Feds make mention of their balance sheet and start selling off assets, that should give the dollar a little bit of a push. We've already factored in, all in the markets are already factored in a fairly dovish Fed with a rate increase, with a slight delay from the September towards the December outlook. Okay. This is what the markets are figuring. If any of those miss, in other words, if the Feds do not say one of those things, or they are in an opposite position, you will see a reaction in the markets. But I don't think you're going to see a knee-jerk reaction tomorrow. I think you're going to see a very downplayed overall reaction. So the market should be fairly steady. It's the S&P and the Dow that have been really surprising, and especially tech stocks. Tech stocks got killed last Friday, but look at this. We see the Dow. Look at what the Dow's done today. Last few days. Look at this rally. I don't know why. The Dow, again, the Dow will do better. The more dovish the Feds, the better it is for the stocks. So that should support the Dow. We got past the Trumponomics stuff, but we're still back up at 21,327, climbing for new highs, and it doesn't look like it starts. If the Feds come out and they're fairly dovish, we might see a strong rally in the Dow and the S&P. So let's go back to my PowerPoint for a second here. Okay. Now, when we look at the total number of contracts and the number of traders trading in the market and the number of long and short positions, we have a lot of activity. Okay. The gap shriveled this year as traders speculated the Feds would be less aggressive in raising rates, partly amid fading prospects that Congress would pass the fiscal stimulus. Okay. Now, we had all of these rallies in Trump when Trump came in office. Number one, on his tax breaks. Number two, on his infrastructure spending. And none of the things he has been promising have actually materialized or happened. I'm not talking about Trump politically. I'm not talking about whether he's good, bad, or indifferent. The markets all rallied and expected these. They expected this huge spending, especially his wall spending would have brought a huge amount of dollars into the S&P and the Dow. Whether it's right or wrong, I'm not commenting. We're only expecting how the markets would react. We would have expected a better, stronger economic growth if he would have gotten some of this stuff in order right away. Because the markets figured, he was promised to do all this in his first 90 days and he's accomplished nothing. So in recent weeks, the spread has stabilized and started to edge higher as traders brace for the Feds to follow through on the projected third 2017 rate hike, while also announcing plans to shrink its bond buying holdings. Stronger than expected economic data, a more hawkish Fed, and a potential successes by Trump in implementing legislation would weaken the bullish case. Fed officials speaking Friday expressed no disappointment in the payrolls gain of only 138 last month, which was below economists' expectations. Philadelphia Fed Patrick Harker called it a good number, while the Dallas Fed President Kaplan, if we are not at full employment, we are moving closer. And remember, the U.S. Fed has two mandates only, full employment and maintaining inflation. And employment is very good in the U.S. I mean, even though the new jobs number created was very low, so was the unemployment number. So when you have full market creation, when you have full employment, you don't get that many jobs because people, you don't need new jobs to be created. You just need unemployment to remain low. A key element in the Fed statement will be the Fed's funds rate projections. With the dollar vulnerable to sustained selling, if there's a total of 3 rate hikes for 2017, appears to be in serious jeopardy. And as you can see from the dip in the dollar, this is exactly what the markets are expecting. Some type of delay, whether they push it back till December, because if they push it off September means they're worried. That means it may not happen in December, or if they take it off the table at all. A hallmark of Janet Yellen's stewardship of the Federal Reserve has been a determination not to surprise the markets concerning policy decisions. The 3 rate hikes sanctioned by the FOMC under Yellen have all signaled in advance, with the Feds not moving unless futures markets have indicated at least a 75% chance that there would be a move. Okay. Now, what we want to listen for. There's ample time to assess data during the summer period before having to decide on their next move for the Feds. Okay, if the Fed continues to forecast a total of 3 rate hikes in 2017 and further steady rate hikes during 2018, the overall market impact should be measured, because that will be what the markets are expecting. There won't be much volatility. There will, however, be a stronger reaction if the Feds cut its consensus forecast to rate increases for this year, and there is a downgrade of expectations to next year. The Fed has said that they will begin to shrink its balance sheet early as this year. Many market pros expect some action on the balance sheet around the December meeting or early 2018, after it raises rates in June and September. But we may see a shift from June and September to June, which is this meeting, and December. The Feds will also be very deliberate in reducing the amount of securities held on its balance sheet from roughly $4.3 trillion to ultimately, over the long term, coming back down to $2.75 trillion. The Fed could reduce its balance sheet by ending its policy of reinvesting in treasuries and mortgages, which would be very, very simple for the markets. Means today when a treasury or a mortgage reaches security, the Feds buy it back. If they just slowly stop buying them back as they reach maturity, it's an easy way to ease off the balance sheet. The Treasury noted in its refunding statement that it would have to increase issuance when the Fed stopped reinvesting. Yes, because the Treasury sells the bonds, the Feds buy them up. It's a big cycle of moving things from one side to the other. So the Fed Watch tool, Fed Watch data, as you see here, are expecting overall a rate increase to about 1 or 1.25% over time. And that's all the way up. We can see that we're up to nearly 100%. So the data reflects market participant sentiment about the upcoming Fed decision. Probability calculation is based on the Fed's funds future rate. So where do we see almost 100% factored in. According to the data available, the market participants have been increasing their total hedge exposure since the end of April. This number is 94.6 for the target rate of 1 to 125 basis points. Least inclusion, the markets are waiting for the increase. Fed policymakers are stuck with the idea of 3 rate hikes in 2017. They're more or less buried into it. So it makes sense to be hedged. Furthermore, market expectations for June rate increase have never been lower than 50%. Starting with May, this trend continues at a steady pace. So the funny thing is, though, if we look at gold, we see some perfectly interesting, perfect chart formations. If we look at gold's moving average, the 50-day and 200 moving average, we see a perfect crossover with an accelerated momentum. We also see gold forming into a perfect triangle. Okay. So if we understand chart patterns, we can either look for a breakout or a continuation, because we're getting very much in this congestion but this is long-term trading for gold, because this is where we are for June 17. On the longer term front, we also have the perfect reverse head and shoulders pattern. We can see that the shoulders, the first shoulder developed here in May of this past year. We had the full head here. We now have the finished development of the right-hand shoulder, and this means that we should see the market. If we see the market break above here, we're going to see it continue up. Okay, so we have a perfect head and shoulders point developing here. And once again, we see all of this congestion that's happened with the breakout and the crossover between the 50 and the 200-day moving average. We also see we saw a huge increase over the last few months of long positions. We saw it ease back off, but now buyers are moving back in long-term positions, and we see the overall speculative positions are net long for gold. So we might see gold rally. It really depends on the Feds, but you have to know what to watch for. All eyes will be on the Federal Reserve for signs on how it will follow through with a widely anticipated rate increase and how that will bear on cylindrical stocks like tech, which experienced a sharp sell-off on Friday. Tech stocks took a beating. Now, they've recovered a little bit yesterday, but it might be an opportune time to grab some tech stocks or to buy into the NASDAQ while they're all down. The Dow industry average, which closed at a record, was the only benchmark to finish higher Friday for the week. And even with a 3.9% decline in Apple, as tech stocks drove both the S&P and the NASDAQ index lower. Okay. Now, the S&P often achieves a high in spring, but in summer it often consolidates and investors re-examine their views and valuations and prepare for their desired positioning into year-end. The September to October is usually a make or break time for the markets. It is a risk-reward appears attractive into year ends. Now remember, we have massive seasonality because also as lots of brokers, especially U.S. brokers, take vacation through summer, a lot of them will move out of the stock markets and move to safety or move in the sidelines because they don't want to be stressed while they're on vacation. U.S. vacation starts from Memorial Weekend and will go to the first week in September. European vacations, remember, you see the same thing in August when the Italians go on vacation, the French go, because the brokers don't want to be, especially the big hedge fund managers, don't want to be left in the market while they're on holiday. So the best one I can quote from is a word from Goldman Sachs. If these conditions are maintained, Goldman wrote that that could mean that the technology stocks have more room to run. However, the bank sees this outcome as unlikely. With the economy of full employment and easy Fed risks the possibility that wage pressures build and wage on corporate profit margins. It wrote, our base case is that above trend economic growth will eventually push inflation higher. And this is something we're always watching for because the Fed will have to react to inflation. Prompt an accelerated pace of the Fed tightening and lead to higher bond yields that will reduce equity variation. So if you don't understand, it's a game. It's like a seesaw. It's a very difficult balancing act because the Feds have to make sure that inflation doesn't surprise them. Okay. So if we have full employment, people have more money to spend, they start spending more money, companies start raising prices, prices go up, or we get a little dip in oil prices, and inflation starts coming in, the Feds will be forced to raise interest rates faster because they've got the only way they can control inflation is by rate increases. They can't wait till inflation is out of control or bearing its head. So it can be a two-edged sword because we can expect, the economic data isn't so great, the Feds were kind of dovish, but we get a peak, if they, in their thing, they get a peak in inflation, they're going to start raising rates even faster. We'll see the dollar go up and gold tumbling down. Okay. Now, such changes won't mean a market sell-off, Goldman added, but we think that the trajectory of price gains will be slower than the pace of earnings growth as monetary policy and valuation multiples each normalize. That weakness won't be spread across the entire market. Goldman suggests that financial stocks, which have lagged behind the overall market in 2017, could outperform. If investors recalibrate expectations for inflation and Fed policy to match the growth optimism suggested by the S&P 500. And this is from Goldman. I'm just reading what they said in their most recent report. Now, looking at the overall market volatility, we have none. The markets are not volatile. Traders are not stressed out at this point. So we have the VIX at a very, very low, and that's why gold isn't soaring. And like I said, we have this ease back off of North Korea. The markets aren't reacting to Qatar. So a Fed rate hike is baked into the markets at a 99.6% probability for a quarter of a point. And it's just at 0.4% probability at a half of a point. We doubt very much she'll go to half. With this rate hike, the only black swan we get is we don't get one. In other words, if we don't get a rate increase, the markets are going to be shocked. People will listen to what the Feds have to say. It's nice to have insight into the balance sheet. Now, continued controversy out of Washington is also weighing on the mind of investors. While some may argue that probes into Russia involvement in the 2016 election are hampering President Trump's ability to cut deals on tax and health cuts, the patience of investors for excuses is wearing thin. We have former FBI, Comey's investigation. We have today's Sessions. The fact is, I don't know what happened with Russia. I don't think Trump did anything underhanded or really wrong. I think if he did anything, it was stupid. And even with Comey, I think he did unprofessional, stupid things that fit his personality. But a very good article in the market said if he just came out and apologized and said, look, he's not a politician, he's a businessman, and he does things by the seat of his pants and didn't know that these were wrong things to necessarily do. They wouldn't be wrong for business, but wrong for a president. And he's going to learn as he's in office. Everybody would walk past it. But, his shouting and his denials and everything else just make it worse. Investors are instead now focusing on fundamentals and so far like what they've seen. However, if corporate earnings don't keep pace or the economy keeps lagging or tech stocks get bubbly, that could start making the market look even more expensive. And if anything is keeping market pros up at night is the question of valuation. So the markets are getting very, very high. So keep all this in mind. Listen very carefully or read the statement very carefully. Believe me, there's not going to be any short-term 15-minute, half-hour trading events, knee-jerk reaction. So you'll have the time to decide what to get into. Evaluate everything that the Feds have to say. And don't just take it on the surface. Compare it to understand what the two-edged sword will be, understand what they can be saying, but what could happen, and then find your position with the assets. Like I said, you might get a good shot in the euro, US dollar, or it crosses off the US dollar. I don't think the market is going to be as dovish as Yellen. I don't think Yellen's going to be as dovish as the markets expect. I don't think because I think overall everything is good. We're all distracted by headlines, and they're not paying attention to headlines. And so I hope you know what to look for tomorrow, and good luck trading the Feds. Have a good night, and thank you for supporting Alvexo, and thank you for being part of the investing.com family. Have a good night now.